Hi everyone, Marcy here. Welcome to our next part of the anatomy series. Today we're talking about loan modifications, and this fortunately or unfortunately will not be very long because loan modifications are probably the easiest of all the types of loan signings. They're one of the smallest and certainly probably have the least amount of notarizations. So when we talk about a loan modification, the general definition is that a loan modification modifies the terms of their existing loan. Now, loan modifications don't have to be just for mortgages. Sometimes they can be for auto loans or personal loans, but the majority of modifications that you are going to see will be for mortgages. Also, there's a preconceived notion that typically when someone modifies their loan modification, their loan using a modification, that it's a negative thing, that they've fallen behind or they're in default. And while that's true, there is some circumstances that would call for a loan modification. That's not always the case. There are actually positive reasons to do a loan modification, or I mean, not positive or negative, just a reason to do a loan modification. So, in general terms, a loan modification just modifies the terms of the existing loan that that individual holds. Some primary reasons, or most common reasons that you see loan modifications, are to prevent default if they've fallen behind, if they're in danger of going into foreclosure, things like that. The modification from the lender assists them in that not happening so that they can keep their home or not fall further into debt. Financial hardships. This would be prior to a foreclosure, maybe even prior to a default. So let's say taxes have gone up exponentially in their area and that payment is much higher than it used to be. Maybe the lender does a modification to assist that borrower so they don't have to have those big hefty payments. And then changing the loan type. Sometimes it's just easier than changing and going through a full refinance, and certainly less costly. So something like you have a construction loan, and then it would convert to just a regular conventional loan, or you have a small bridge loan, or you have a proprietary loan through, let's say, a credit union or a small bank, where your term might be 10 years. And at the end of that 10 years, you have a balloon and then you owe obviously the rest of your mortgage. A modification would come in and just adjust those terms. So it would take away that big balloon payment and go ahead and allow you to make payments over the course of the next 10 or 15 or 20 years. So these are the actual types of loan modifications. And I think these are probably the ones that you'll see most frequently. They're not the only ones. Like I said, you can really modify a loan for almost any reason, but this is what you'll see most of the time. So the first one is an interest rate reduction, and that's obviously lowering the interest rate because it'll reduce the monthly payment. Sometimes it's an offering for individuals with a really great credit history, or they've been longtime customers of that particular bank. The bank is offering an incentive, or they're in or possibly going to go into default. And so the lender wants to make it a little bit easier for them, or interest rates have dropped dramatically, right? We're not seeing that obviously today, but in the past, during COVID, we saw lots of people who were eligible for 2 and 3% interest rates. They were coming from a 7 or 6%. Easier for the bank, easier for the signer just to go ahead and do that loan modification. Term extension is another one. So it's possible that they're in default, or that payment has increased due to taxes, or their default, or insurance, things like that. And so instead of changing the interest rate, they extend the term. So maybe there's only 10 or 15 years left on their mortgage. They can go ahead and modify it and now stretch that 15 or 20-year period to 30 or 40 years. It certainly depends on the lender and what they would allow. But term extension is another pretty popular way of still the lender getting their money, obviously, but the borrower being more able to afford those payments, or maybe they just want to extend that out. It's not even maybe they can't afford it, but they have other obligations. They feel comfortable extending their term. That's what they'll do. Principal forbearance. Sometimes the principal balance is temporarily deferred to lower the monthly payment. So This would happen sometimes in terms of default. Maybe the borrower fell behind 1 or 2 payments, and instead of now having to make 3 payments at once, the lender takes what's in default or behind and moves it to the back end of the loan. So that way they're still going to make the payment. The lender still gets their money. It's not forgiven or goes away. But in essence, the borrower is caught back up. That's another pretty common one, especially when we're talking about potential foreclosure default. The borrower submits documentation to the lender, show that they can continue to make payments. That lender in turn kind of gets them back to square one so they're not behind. Principal reduction. This doesn't happen very often, but sometimes a lender will waive part of that initial loan. And this is a very rare circumstance. I don't expect that you see very many of these. And there's a very specific set of reasons why that might happen. Sometimes it's they're removing maybe a portion of the property to sell someplace else. So they have like 15 acres of land, and they're just subdividing up the house in 5 acres and selling off the 10. They'd make an adjustment to the loan to compensate for the release of that property. There will be an actual release that gets filed, and that kind of digresses from this conversation. But it would be those kinds of circumstances, and it would really be something that you wouldn't see very often, but certainly could happen. And then changing the loan type. And that would be like I talked about, going from a construction loan to a permanent loan, going from a balloon to a regular term, so there's not that big balloon payment. Sometimes going from a hard money or a bridge loan to a conventional loan. So sometimes people borrow large amounts of money at high interest rates for a short period of time, like 6 months to a year, to get them to the places they need to be to refinance or buy something. It's just like a little money to carry them over. And then at the end of that, all of that money is now due. If they borrowed a lot of money, it would be hard to pay all of that back unless they borrowed it while they're waiting to sell their home or for some other reason like that. But most of the time, that loan then would convert. And the easiest way to do that would be to use a loan modification. Any questions about any of that so far? I think I have a couple of chat questions, maybe. Nope. Okay. If you have any questions, you can certainly drop in the chat or the Q&A, and we'd be more than happy to answer those. All right, eligibility. So depending on the reason behind the loan modification, and I put this in here because it's just nice to know the backstory, there typically is documentation that has to be sent off to the bank for them to approve a modification. And that really depends on what the type of modification is. If it's a hardship, a financial hardship situation, may have to prove financial hardship. And that would be submitting income documentation and probably letters or supporting evidence. Maybe they had a medical emergency. Maybe they had something happen in their family. Maybe they lost their job. Supply that documentation along with a budget typically. So a lot of times they'll ask them for utility bills. They have the mortgage statement as well, but like what they pay for daycare, things like that. So they can kind of get an idea of what your budget is, what you're spending, to see what they can fit you into to make that modification work for you. Sometimes the lender requires for those that you be in default, right? That you already have missed a payment or two when you're moving toward a foreclosure. Sometimes loan modification programs require that you be current. And those are opposite. They require that maybe you are looking for, like I said, to remove a bit of parcel from your land, or you want to change the terms of your loan. In order to do that, they want to make sure that you have a good credit history and that you've been making payments all along. And in that case, they would require you to be current. It just depends on the modification type and the program that you're looking to apply for. They also have to include all the documentation, like I explained to you. No matter what type of modification, there's always usually some type of documentation that's required from the lender. And sometimes the modification is already predetermined. And I go back again to construction loans. Typically for construction loans, the way that those work is that there's that construction loan, obviously, piece where you get money to build a home. And you're told up front, hey, the loan will convert once the construction is done to 10-year, 30-year, whatever the terms are at this interest rate. And of course, your payment is determined at that time because they'll know what the assessed value of the property is and all the things. So sometimes that modification piece is decided up front. You already know there'll be a modification down the road. So the details of an actual loan modification, if you haven't done them, is they're a much smaller package. And most of them, for the most part, are 50 pages or less. They're really not large packages. It's usually at the very minimum, the loan modification itself, and then as a recordable document, it gets recorded at the county clerk's office. They're typically only a handful of notarizations. So sometimes within that package, there will always be the loan modification document. And then you might see a few additional documents, like the first payment letter or initial escrow disclosure, because typically during construction phase, they may not be collecting taxes or homeowners. That won't happen until later. An occupancy affidavit, now that the home may be built for a construction loan, they want to verify that you are going to be living there. If it were some other set of circumstances, like a change in term, they might want that as well to make sure you're still living there. If there's a correction agreement in there, they want that to make sure that going forward, they can make any of those corrections no regular refinance. So you might see a small handful of documentation in there that you would see typically in a refinance package as well, pertaining just to this modification. But again, that would be a small handful. And typically, I would say for most loan modifications, we're talking about maybe 10 or less notarizations in that package. So much smaller package, much quicker, much easier to get through. I have a blank screen here. Oh, my window, my share screen stopped. What happened? If I can go back to my power. Let's see. Doesn't seem to want to work for me. All right, I think, oh, there we are. Can everybody see that? I don't know what happened there. It kicked me out. It's going to kick me out again. Okay, well, I'm going to stop the share and I'm going to try to share the loan modification document itself. Let me all know if you can see this.
Yes, we can see it.
Great, thank you. So I left this blank for two reasons. One is that I wanted to make sure that you kind of got just the logistics of what it would look like. And two, these blank fields are typically what changes from person to person, loan to loan, right? It goes through and it references the original loan documentation that's filed with the clerk's office, a mortgage or the deed of trust, whatever that might be. It's usually a very small document. This one happens to only be 4 pages, but that's not necessarily always the case. It could be anywhere from, I would say most modifications run between 6 and 8, maybe 10 pages. They're not usually very long. And it just depends on this middle section, what the modification or change might be, what the reciting of it is. But the important thing to know when you do a loan modification is there will be a section for the borrower to sign, and I've highlighted that in orange. The borrower signs, and you notarize the borrower's signature, but there is also a spot for the lender to sign. Sometimes the lender pre-signs, and when you get loan modification, you'll see that signature on there. Sometimes they do not. So the important things to remember when you do a loan modification is that the borrower signs, and they have their own acknowledgement here, but the lender will sign as well, and they have their own acknowledgement. So what you don't want to have happen is you don't want to notarize in the lender section. You only notarize in the borrower section, if that makes sense. Sometimes there will be an additional line for MERS, mortgage electronics registration systems. So the lender signs, the entity on behalf of MERS signs, and the borrower signs. Same thing. Then there'll be 3 acknowledgements, or maybe 4, depending on how many borrowers that you have. But you always want to make sure the only one that you're notarizing is for the borrowers. Unless the lender happens to be at your closing, or that MERS rep is too, you can notarize. But these are the systems here that you want to make sure you follow. Just the borrower, never the lender section. And if you make a mistake, just swap out those pages. So loan modifications, I know that was very quick, are really very easy. They're the easiest of all, I think, of the loan packages. They take the least amount of time. Typically, when you get there, the individuals are well aware what the modification is for. They've either already seen the modification or the terms have been discussed with them. I just said to someone the other day, very rarely have I had anyone cancel their loan modification. It's usually something they're really wanting to do. They need it for whatever reason, or it's already been discussed. So loan modifications, I think, are a great way to step your dip your toes into the water if you're looking to do loan signing. Are there any questions about loan modification? Okay, good to know. Like I said, these are the easiest of all of them. I appreciate you all coming. Thank you so much. Our next in the series is the anatomy of estate documentation, which fortuitously will be happening in about 45 minutes. So grab yourself some dinner, something to drink, a snack, and we will see you back here at 7.
Oh,
Thanks
Marcy,
so much, everyone. Have a great day.
John did have a question.
Oh, John, I'm so sorry. Go ahead.
No, it's okay. It was right as you were.
Oh.
Do we receive loan modification signings through signing and mortgage companies?
Yeah, you can receive them through signing companies. You can receive them directly from the lender. You can get them from attorneys. Loan modifications are one of those things where they can come from all sorts of places, depending on what type of modification it is. Finance companies. So if it's an auto loan that's being, redone, if it's a credit union that is redoing someone's loan, again, if there's a car payment involved or a personal loan, they're modifying the terms. So there really isn't any place that wouldn't necessarily do loan modifications, but you would get them traditionally from the same places that you get regular loans from. And that's a great question. Thank you for asking that, because it's important to know where you can get those from. Any other questions? Okay, great. Thank you all so much. We're going to end this, and I'll see you back here shortly.
Aye.